I'm Coryann Stefansson, and I'm here at RiskMinds America in lovely Chicago. I'm joined by Dr. Richard Petersen, who has been called Wall Street's top psychiatrist. Dr. Petersen is a managing director at MarketPsych, and he's here to talk to us today. So maybe, Dr. Petersen, can you talk to us a little bit about what sentiment analysis is?
Sure. So sentiment analysis refers to the analysis of news and social media text to extract out emotions and feelings and opinions of people who are writing, for example, on social media, or if you're a journalist, what they're expressing in their articles. And when we quantify those references, we turn them into a time series of scores of information that can then be tested quantitatively to see if we can predict things like asset prices, stock prices, currencies, et cetera, by understanding their feelings.
Wow, interesting. Yeah. So do you find that financial institutions are using this type of science when they're thinking about how their consumers or their clients behave?
Well, that's a good question. Most of the people using this type of data are using it, or at least from my perspective. We sell the Thomson Reuters MarketPsych indices, and it's sold through the machine-readable news department at Thomson Reuters. So it's actually sold largely to quant funds and people who are what we call data hogs.
Right.
They want a lot of data, they run it through their servers, and their algorithms, machine learning typically, will identify patterns that can be used to predict asset prices. So, but then there's the other side of sentiment analysis, which you were referring to, which is consumer sentiment. There are quite a few people doing that, monitoring, for example, if somebody loses their bag at an airline, and they tweet about it, the airline will hear about it through one of these third-party vendors that, hey, your people are complaining about your baggage handling services, you should call them up right away. And so they'll often tweet right back to them. So there's that type of sentiment analysis, but what we do is different in the sense that we're creating these large quantitative time series for testing and modeling of asset prices and economies and financial markets.
Wow. So now back when I was in university, I remember taking a class in behavioral economics.
Oh, yeah?
How is that
Nice.
related?
Oh, so behavioral economics is essentially the branch of the science that focuses on individual decision making. And we know that individuals make what we call predictably irrational decisions. That's what Dan Ariely coined that phrase. Systematically, again and again, people will make the same type of mistake in a given situation. And it leads to industries like payday lending, where people don't really think ahead to how much interest rate they're paying, and they'll get caught in this debt spiral, for example. It also may fuel things like excessive credit card borrowing, et cetera. The little behavioral idiosyncrasies we have can be taken advantage of in the consumer industry by these different groups. And at the same time, groups in the UK, for example, the Financial Services Authority has legislated that brokers need to investigate how to help their clients make better financial decisions. So now some regulators are jumping into the fray and saying, using what we know from behavioral economics, we know that people are making a lot of bad decisions, and they're doing so in a way that can be taken advantage of by industry. So we want those same potential predators in the industry to actually turn around and help you to show that they're doing what they can to make us not fall into these traps.
Right. So as I understand it, then you can have, there's uses on both sides, one where it helps from a predictive perspective that helps a trader or an investment manager, PM, have more information to make decisions about which assets to purchase. On the other side, one could think about a way, maybe even risk managers could use this type of information as they think through where potential vulnerabilities are.
Definitely. Well, one thing we see a lot with the risk management is when the data shows people aligned in one direction. I showed you in the talk today an example of Tesla. So every time they release a product, there's very positive sentiment about Tesla, typically in social media, which also precedes a collapse in the stock price for the next few months. So when there's this crowd and when there's this uniformity of opinion that Tesla is the most awesome company in the world and their products are terrific, that is a crowding type of risk.
It's the crowded trade.
It's the crowded trade. Yeah. And this social media allows us to detect the crowded trade, not just by the volume or by what other traders are saying, but in a systematic, scientific way.
Right. Yeah. That's interesting because there's always been lore in the trading world that you want to sell when everyone else is buying and buying when everyone else is selling. It's like that contrarian type of view.
Exactly. It's exactly that. And it's not always true, of course. So we're always true would be very easy. But it's a probability game. So maybe 60, 70% of the time you can identify these opportunities that way. In fact, I did not mention at the talk, but we've been trading a model, a machine learning model ourselves through our asset management company, MarketPsych Capital, since February of this year. We started trading on the S&P, and that's been doing very well, just predicting how subtle shifts in the daily tone in the media will predict the next day's price action in the S&P.
Wow, so it's actually able to absorb the data and do some sort of analysis based on news clips or people, or is it based on people's behavior and then it uses that to predict what assets to buy?
Well, it's the same, so it uses the same data that we sell externally.
Right.
So we also receive that data from Thomson Reuters through this other company. And then we transform that into features that can be fed into a machine learning model. So essentially indicators, sentiment type indicators. Once those are transformed, and then the machine learning learns the patterns from 1998 up until now, how every day's change in the tone of the media likely preceded the next day's action. So if the trust goes up and anger goes down, and joy goes up and optimism goes up, what does that mean about the next 24 hours?
That's amazing.
And actually, but it's interesting too because the machines seem to be able to incorporate that much better than
humans
techniques.
because they can take out, say, the emotional aspect.
And they can consider 50 different factors, while a human really is just focused on the 2 or 3 right in front of them.
And they might have a bias in the way that they do, where that computer would take. So, wow, so I can get an Uber that has a driverless car, and I will have a PM, maybe a fund that is also PM-less. It's interesting. We have a lot more free time in the future.
We named our machine, though. We called her Pythia, which is the name of the oracle at Delphi.
There you go.
Yeah, so we had to name her to make her human.
Exactly. Give her some human
And a
traits.
gender. I gave her a gender just now, too. So.
A female. Well, that's good. A female PM.
Yeah,
that's
more
good
reasonable.
To hear. Very good. Very
multitasking with all that information.
Exactly. Well, thank you so much. I appreciate this
sure,
conversation.
My pleasure. Yep. Thanks, Coryann.
Bye-bye.